You might have clicked on this video because you're interested in learning about how equity crowdfunding works. Well, we're going to talk about that, but we're going to spend most of the time talking about why it's so risky and why it's probably not a good idea for retail investors to get involved with. So let's start by talking about what equity crowdfunding is. You may recall the start of this movement was really around the Kickstarter and Indiegogos of the world. And the idea was that companies would come up with a product that people would want to buy. The people would pay for the product in advance, so they would fund the project, and the company would get to work on it. Well, that was riddled with all kinds of disasters, and some of those we covered. This presentation and the accompanying research pieces won't focus on that, but we've delved into that quite deeply. Then you have debt crowdfunding. This is an interesting idea, and we actually dabbled in this for a while with Lending Club. And the idea is that let's say you have uh, an amount of money, $10,000, and you take that and you loan out $100 to 100 different people. Well, there'll be a certain percentage that default, but as a collective, that portfolio of loans is a lot less risky than if you just loan to somebody $10,000. So that was actually a very interesting idea. Then you have equity crowdfunding. And the idea here was that people would fund a company and receive equity in return. And this became quite popular when the US government laxed regulations around what retail investors could participate in. So the idea is quite simple. You have a company that's looking for funding, and a lot of different people pitch in money to fund it. And so maybe you'd have 100,000 people pitching in $10 a piece, then you've got $1 million, right? So little amounts like that are a lot easier to get than bigger amounts. So people started to fund different startups, and a whole plethora of platforms emerged that would allow firms to go raise money using equity crowdfunding. So let's talk about what you're investing in when you do that. So startups are typically companies that are funded by institutional investors, or they're often bootstrapped for a while, but typically they'll take institutional funding because they want to scale very quickly and they want to exit. So the whole goal of a startup from the perspective of institutional investors is to hit an exit. And venture capitalists are people who go out and look for startups to invest in, and they use the spray and pray approach. So they find 100 companies to invest in and hope that two are unicorns, or that are real big success stories. So startups are inherently risky. So there's all kinds of estimates out there. You've probably heard the common one, which is that 9 out of 10 startups fail. And these are typically firms that have professional investors alongside of them. So this first bullet point is from CB Insights. It talks about how 70% of upstart tech companies fail, usually around 20 months after raising their first financing. And the number one reason companies fail, this is very important, 42% of polled startups, the number one reason said it's the lack of a market need for their product. So they developed a solution looking for a problem. And that's why we don't invest prior to meaningful revenues. You even see that on Shark Tank. They'll take that same approach. If you haven't sold something, you have nothing. So you should never invest in firms that haven't sold meaningful amounts of product or service. And by meaningful, we quantify that at around $10 million. So just based on failure rate, you'd need to invest in 10 startups to have a chance of one exiting. So the fact that a lot of people come across a crowdfunding startup and fund that single company, the odds are not in your favor at all. However, startups represent a very exciting asset class that's not correlated to equity. So it actually gives you exposure as an alternative asset class that will behave differently than the stocks you're holding. So it's good to have that diversification effect. Well, there's a number of ways that you can get equity in startups. And over my career as a software QA engineer, the first half of my career I spent working for large companies and startups, and this company was one of them. So I was employee number 8 at Amfire. I was poached from the firm that I was at by the founder, and We set about transforming the food distribution industry by building an online solution. It's pretty much what it says on the tin. There was a lot of inefficiencies to be realized there. And I recall one Monday morning standing there with a coffee cup in my hand full of vodka, and the HR lady came by the office and flashed her tits on the glass, and everybody had a good laugh. And I was thinking to myself, wow, what a great place to work. And it certainly was. We knew how to work hard and we knew how to play hard, and everybody there had ownership. And our ownership was cut down when an investor came in and we had to take funding. Of course, it diluted everyone. And I eventually, when I left, ended up purchasing about half of my options. And then I would say 5 or 6 years later, when I was in the UK, I was notified that the company had merged with iTrade Network, and we had an exit. And I recall the money was somewhere around 125, 150% return on my capital. So it wasn't anything life changing, although we had all hoped it would be. And one of the reasons it wasn't is because we had to dilute ourselves so much. But that's one way to get equity in a startup, is to work there. I actually had equity in 3 startups, and the other 2 fizzled out. And the second way would be via a venture capital fund. So you usually need to be quite connected to get involved with one of these funds. You need to have a lot of money. Or you can look at publicly traded VCs, so we wouldn't really recommend those. There's some interesting names out there. Alumni Ventures, that's a firm that we really liked when we looked at it, but I noted there was some news around they had misled investors or something like that. Certainly, do your own due diligence, but it's an interesting idea. You can also invest through secondary markets. The problem there is that the minimum, so it's like, $25,000 minimum. Well, that's prohibitive for most retail investors. You need to be careful about tokens. So these days, they're trying to spin tokens as equity, and you always need to probe that, because typically tokens do not equate to equity, but everybody treats them as if they do. Helium's a good example of that. And I'll put a link to that article in the description of this video, along with a lot of other research pieces that were used to produce this. Reg A plus IPOs, anytime you see that, just walk away. It's just not worth it. These are firms that, again, go to retail investors to raise money instead of institutions. And of course, the riskiest method, the one we're talking about today, is equity crowdfunding. And one of the reasons is that there's no vetting mechanisms in place to keep people from taking advantage of retail investors. We sounded the alarm 7 years ago in this first piece, a warning about crowdfunding, and wrote subsequent pieces that cover this as well. When you look at stakeholders, I remember my first job, my first boss said to me, always think about what motivates other people. And it's very important when you think about the stakeholders and what motivates them. Startup founders, they just want to raise money. I mean, funding is funding. Platform operators, they get a commission, so they just want to do as many deals as possible. And then you have retail investors who are marketed to and foot the bill. So one immediate problem is, how do you value the company? Does it even matter? And we're going to show you examples today of why it doesn't really even matter. The way that you solve that is you invest alongside, not after, alongside venture capital firms. That's an absolute must, because then you know that you're getting a decent valuation and somebody did the due diligence. And even then, 9 out of 10 will fail. And remember this, this is the biggest takeaway from this presentation, is this: your shares are worthless unless there's an exit. And there is not often an incentive for a company to have an exit or a capability. And what you'll find when you start looking at these quote unquote opportunities is that red flags abound and quality is lacking. So this is a piece that we published, it was last year, and a fairly notable law firm in New York had sent us a letter, a cease and desist letter, multiple letters actually, demanding that we remove this piece. And when that happens, it's a big red flag. We've had this happen a number of times over the years, and it's always been when we poked the ant nest a little bit too much. Everything that we said was factual. They didn't like it. They had the money, and we had to redact this piece. This was about a firm that's raising money via crowdfunding. So that in itself is a huge red flag, and it's reminiscent of over-the-counter stocks. And when you look at the quality of these companies, just a lot of rubbish. So we did a piece on a firm, I think this is MicroVentures, and here are some examples of funded projects or companies on their platform that, you look at this stuff, vegan restaurant, a grilled cheese food truck, beer dispenser, board games, horror films, things that are very difficult to be successful in, but that don't offer a lot of upside. So the quality of companies that you come across is very poor, and that even is the case for brand names, like, for example, High Times. Now, back when we ran ads on Nanalyze, this ad kept popping up, so we wrote about that. We stopped running ads specifically because people were targeting our audience with rubbish. And this is an ad that popped up. We took a look at, oh, look, High Times. Everybody would remember what High Times is. And if you're not from the States, it's, well, even if you are from Europe, you would be familiar with the High Times Cannabis Cup, but it's a magazine events sort of company that caters to the cannabis crowd. And you see here this ad they were running. It says, become a shareholder in High Times before the company's planned stock market listing. That was in 2018. And we wrote about that twice. The first time was when they were running that ad, and the second time was later on as well. And right now, if you go look at their latest filing, they say, the offering is presently paused pending the company's completion of an audit of its 2019, 2020, and 2021 annual consolidated financial statements. Well, it's actually doesn't appear to be paused. And what you have here is a complete rubbish firm. And it's not hard to go out there and dig up articles that cover this extensively, including the ones that we've published. High Times Holding and or its subsidiaries have been named as defendants in more than a dozen lawsuits. Their Reg A offering circular on their website, it's 5 years old. What good are financials from 2018 because you haven't produced them for 2019, 2020, or 2021? How the hell do we know what exactly we're purchasing when we buy shares? They have a loan bearing 15% interest. There's no status of that debt. They're always announcing acquisitions, walking them back. Again, no audited financials, and horror stories abound. When we published these pieces, lots of people reached out and said, boy, I really wish I would have read this sooner, because there's a lot of people that aren't happy about the fact that they've purchased shares in a company that they can't exit from those shares. And when you go to the website now, I just did this right before I started this presentation, and you see here, you can use a credit card and you can plunk down money. And I certainly wouldn't be doing that, so I didn't click submit. But it appears that you can go there and anyone with a credit card can buy, quote unquote, buy shares in the High Times IPO, which never seems to happen. So when you see something like that, you just walk away. And these firms will aggressively market their shares to the public. And here's another one. So these folks are offering a reservation bonus. That's what they'll do. So they'll set up and say, well, you have to make a reservation, a commitment, and then they see how much demand is out there for the shares, and then they'll make the shares available, and then everybody purchases them. And anytime you have this sort of discount, buy X shares, get X shares free, it's just a real gimmick. And they spend more time on marketing than they do on actually running the business. And an example would be Miso Robotics. This one you've probably seen all over Facebook, the ads, and really all over online we see ads for this. And back in 2018, TechCrunch had run an article. It said that Miso Robotics got a big vote of confidence from investors in the form of a $10 million Series B, and that the windfall was led by Acacia Research Corporation. So they had institutional funding at that time. They had taken in 14 million, and it says they're ramping up production, getting ready to deliver hamburger cooking robot Flippy to 50 Cali Burger locations. That was 5 years ago. What do they say today? Well, you can pull up their circular and take a look. It says in November of 2019, they signed a commercial contract with Cali Burger worth $11 million. The contract is for the rollout of up to 100 Flippies across 50 locations. And it says this key point at the bottom: as part of this contract, Caliburger has deployed Flippy to 4 of its locations across the West Coast. What a waste. So they took all that money they were planning to roll out. Nothing ever happened. That's a big problem. And when you look at their financials and you see that here at Nanalyze, we've raised more in revenue than they have, that's really concerning. So what you're really getting is a promise of something to happen in the future, which seems to be rolled forward. So, they make in their filing the point here, and it's very true, that the partnerships, they've been announcing partnerships left and right, do not obligate those partners to purchase any of the company's robots. And they say that it costs them a lot of money and time to develop these quote unquote partnerships, and that they may not realize sustained or any revenue from them. And the second bullet point here, it says White Castle in 2022 agreed to roll out Flippy to up to 100 of its locations. Revenues are expected in the second half of 2022. Well, you better hold them to that, because it's about time that we see some revenues come in. If you look at the cost of producing their product, it's far more than the revenues. How do we even know they have a sustainable business? We don't. It's all just inflated, overvalued a marketing project, more or less. They split their shares not too long ago so that their investors would feel more comfortable purchasing shares at $10 versus $50. That shows you the analytical capabilities of the audience they're targeting. These are individuals who would have no idea what the actual valuation is, which, according to their latest round, they're valued at $500 million. What an absolute joke. So this is not something you would ever want to get involved with. It sounds cool, it looks cool, it's easily digestible, and that's why people are buying the story. Well, there's another story that's easily digestible in the robotics theme, and that's Knightscope. And surprisingly, this firm actually did go public. And here is the offer that they had, that we had written about them, and they were valued at $447 million on minuscule revenues. And they were raising a lot of money. And here on the right, you can see a chat that I had started up. And the CEO is out there on the website, if that's who they say it is, taking questions. That's not what your CEO is supposed to be doing. And you see here that I was asking him questions around the likelihood of an IPO. They had an IPO planned for a long time. Well, it finally did go through, and credit to them for making that happen. But then what it lets you see is that this firm isn't very impressive in the first place. So they had their IPO at $10 a share, traded up to $20 a share on hype. Today it trades at around $2.66 with a market cap of $98 million. You can see here the revenues over the last 5 quarters. They've barely cleared $1 million in a single quarter. That's not meaningful. Until they have more than $10 million, they have not achieved meaningful revenues. Our belief is they're selling a novelty item that's they're not able to sell at scale. And it's similar to Miso, where it seems like all they're doing is, running little beta projects with these quote unquote partners, and never really achieving the sort of traction that we want to see. So their simple valuation ratios around 25. It means that there's still plenty of room for that to fall. They don't have meaningful revenues. You stay far, far away from firms that don't have meaningful revenues. Now, there's another option that's quite interesting. We wrote about this recently, and it's a firm called Securitization, and they're using blockchain to enable fractional ownership of things. And we recently wrote about Spice VC. It's a fund that they've made available. There's no minimum, and you don't have to be an accredited investor. Remember, a lot of these options require you to be accredited, and lots of retail investors aren't accredited. So that's another barrier to entry. Although, to be fair, we need to put up as many barriers as possible to keep this garbage from being pushed onto people who don't know any better. So Securitize is working on, providing liquidity for secondary market transactions. That will certainly reduce, let's say, eliminate the liquidity risk problem. Although, to be honest, the liquidity that they have on their platform could also stand to improve, but that comes with time. So once you have that ability to sell shares, then there's still additional concerns. So what information should be required? So you have High Times with the document from 2018 that they're using to solicit money today. So shouldn't that be updated? Should there be a standard set of documents that accompany these offerings? Filing documentation with the SEC is time consuming. Our belief is that a lot of these firms go the crowdfunding route because they either aren't able to get institutional money, or they got institutional money and they didn't want any more of it. And that's what you see with Miso Robotics. So crowdfunding is for the company is a big effort. And I believe on the High Times IPO, we had looked and they were spending somewhere around 30% of their money on marketing and advertising trying to raise money. So it's a very inefficient way to raise capital. And our belief is that businesses that crowdfund, as the platform exists today, or direct to retail investor, are just not best of breed firms. So just to conclude, the worst type of liquidity risk is when you don't have liquidity. So if you have shares in a startup and it hasn't had an exit, those shares are worthless. Similar to how the shares that I held in 3 startups, 2 of those are worthless, and 1 I needed to hold for a while. Unfortunately, was able to see an exit event way down the road, which didn't provide the sort of windfall that I was hoping for. But that's how life is. This is a very risky environment to operate in. So, even if you have that liquidity problem solved, investing in startups in general is risky, and you need to invest alongside professionals who do this for a living if you want to have any chance at succeeding. Because the way crowdfunding is set up today, all the stakeholders are incented in ways that don't benefit retail investors. We saw the same thing happen with SPACs that we warned about as well. So please put your comments in the comments section. Make sure to like this video, share it with your family and friends, especially your elderly relatives that might come across these sorts of schemes out there and think that they're actually investing in something solid. The fact that you can invest in a company with a credit card is a dead giveaway that something is wrong. So please share this for the sake of educating more people about these pitfalls. Make sure to subscribe to our channel. Thanks so much for taking the time to watch this video today.